Okay, let's get going. It's 11 o'clock. So I'm joined this week by Andrew Mahatty, who's going to be running through what happened over April. And then I'm talking to Laura Foll of one of the managers of Lowland in replacement of the previously advertised guest. Okay, let's get going. It's 11 o'clock. So I'm joined this week by There we go. Excuse the slight noise thing. There we are. We've got it running there properly. So a bit of news this week. So Aberforth's bit of income. There's announcing what they're up to as we approach the end of that fund's life, and then Chrysalis announced a quarterly NAV. So Aberforth first. This is a fund. It's a split level fund. There aren't very many of them. It's traded very close to asset value for all of its life, as you can see here. It's not huge. It's a mix of ordinary shares and zeros, and the market cap of the ordinary shares is 155 million. It was launched in July 2017 as a rollover vehicle for a fund that was called Aberforth Geared Income. And the ordinaries and zeros were launched in a ratio of about 4:1. And because interest rates are that much lower then, the zeros were issued with a gross redemption yield of 3.5%. So basically they accrue that all the way through the life of the fund, and then they get paid out the fixed capital amount at the end. They get paid in dividends or anything in the meantime. And the gearing that Zeros provides helps boost the income on the fund. It's obviously quite attractive if you're an ordinary shareholder. And it also gears the returns on the capital side too. So had it performed really well, it would have magnified that. It always had a planned winding up date of the 1st July 2024, and it's benchmarked against what is now the Deutsche Numis Smaller Companies Excluding Investment Companies Index. This is from the end of March fact sheet, so you can see where the fund was standing then. And unfortunately, in terms of both NAV and share price, it's underperformed the index, and that index has underperformed the all share. So obviously, we know that small caps underperformed, and I'll explain why in a second. I think the fund has underperformed. The total assets figure is probably a better measure of how it's done. That just gives you what the portfolio performance has been like, but it's still below, well, marginally, the Small Companies Index. In terms of income, they started off targeting a 4p dividend, and they managed to achieve that, but they had to cut it during COVID because the income wasn't just coming in. But this year they're going to pay like a bumper dividend of about 6p. Some of that is coming from special dividends, and some of it's coming by paying out all the revenue reserve because things come to the end of its life. Small cap, we're going to talk about a lot more later on, but obviously it's been a difficult market since 2017. And actually, in terms of market cap, the universe has shrunk. It's always had a kind of value-driven approach, so looking for cheap stocks, and they tend to look at things in terms of EV EBITDA, but the PE ratios give you quite a good indication of what's happened to valuations. So when they were launching the fund, it was trading at 13.5 times price earnings ratio, and they thought that was cheap, especially cheap relative to large cap stocks. But by the end of December 2023, that had gone down to 12.8. And because they're targeting cheap things, the P on the portfolio is only 8.9. So they target value stocks, and for a big chunk of that period, value was underperforming. But that all flipped in the beginning of 2022 when rates started to climb. So they should have had a better period anyway in the last couple of years. But the other problem that they've had is that they've had quite a big exposure to the smaller end of the small cap market, and over half of the portfolio, and that has dragged down returns. So larger companies have generally performed better than smaller ones. So anyway, so we get to the end of this life. What they're going to do? They're going to launch a new fund. So Aberforth Geared Value and Income Trust. Again, it's a split capital fund, so a mixture of ordinary shares and zero dividend preference shares. Both of them issued at £1. We don't know what the redemption yield is going to be yet on the zeros. That will be revealed when they publish the prospectus, which will be around the end of May. I think this is really interesting because it's the first time anybody's had a real go at trying to raise some money since the end of 2021. They're not going gangbusters on this thing, so they're just looking to try and maintain the number of the sort of rough size of the assets they've got under management here. So the old fund was about £200 million. So they want to cap the size of the new trust about around that level. So the new investors will only be able to get into to the extent that existing investors want to get out. So that's the first thing to remember. And also because they want to have a kind of fixed ratio between the ordinaries and the zero dividend preference shares. If too many people want one rather than the other one, they're going to have to be scaled back. But obviously, anybody who wants to can just opt to take cash out. And when this fund was launched, quite a lot of people moved out of the fund at that time. They're targeting 5p dividend for the first year, so down from this kind of 6p that they're paying this time round. Aberforth are making a sizable contribution to the costs, which is going to help get this away, I think. What we'll do is, when we've got a bit more information on exactly how it's going to work, we'll have a look again. I do think it's going to be interesting to see how this goes. It's a good sort of test of the sentiment in the market, really. Chrysalis next. As we know, this is still trading at an enormous discount, even though the NAV has been sort of slowly ticking up. And what Morningstar haven't picked up yet is the latest move in the NAV, which is what I want to talk about. So that's gone up by another 4p or 2.9%. And that's really driven by the valuations of the underlying portfolio, not helped by foreign exchange moving the wrong way. And so this just breaks that down company by company within the portfolio. And as you can see, the big jump here is in the valuation of Starling, which is the bank. But that's offset by a big fall in the value of WeFox, which is the insurance business. But they've got other compensating things too. So Smart Pensions up here, 22.1 million. Again, they've invested on £6 million in that. And the other big movers are Featurespace and InfoSum. What's fallen off the back here is Tactus. So this was a thing that was valued over 40 million. They wrote it down to 8 at the end of December. It now no longer appears in the list of investments. I think they might have written down to 0, but they didn't actually comment on that, which I think is quite strange, but there we go. But not everything's going to be a winner on these things. That's always going to be the way. So in terms of what's going on with those things, what's driving those things, Starling, especially since interest rates went up, has been consistently profitable. It helps that it's got huge cash balances, and it's earning money on those now in a way that it wasn't earning money before. And it's also been able to cash in on the value of the software that underpins how the bank runs. So they've sold that to a Romanian bank and to AMP in Australia, sorts of deals. So that's actually quite encouraging. And then the other one that is good news is Klarna. I've talked about this in an article last week, actually. So basically, there's a story around them using AI to replace call center jobs, and that's saying that's saving them £40 million a year, which is a big chunk through to their bottom line. So that's obviously very good news. WeFox going down, although it doesn't look great, is not all about what's going on in the business. A lot of it is down to the fall in the listed comparators. So that doesn't really crystallize anything. They did reposition the business though, so they stopped this idea that they were going to write their own insurance, and they're just focusing now on the normal kind of business that they've got. We'll see what happens with that, but it was quite a big write down. Smart Pension is just going great guns. The reason they had to put more money into that is just because of the growth. It's growing so fast. And so £1 billion a year of inflows that's something that most people kill for. InfoSum, they didn't really explain why that went up, but I think it was largely because as a peer acquired quite a high revenue multiple, so that might affect the valuation. And there's an unnamed sale. So remember, there was a bit of excitement at the end of last year that they said that they had something in the works that was going to add to the NAV, and then they wrote the NAV up. Everybody sort of commented around the market that's GraphCore, so that would be really quite good news. And they managed to sell that because it sort of free up some cash. So generally the mood is upbeat here, and that seems quite at odds with where the discount is, sort of 49%. So I'm going to now hand over to Andrew.
Terrific. Thank you very much indeed, James. That's it's such an interesting one, Chrysalis, and certainly there's a lot of potential in that one. We'll see how that plays out. As usual, I'm going to talk about what's been moving this month, and I'll also be focusing on discounts and exactly how those have been moving, because I think that's quite interesting at this point in the market cycle. So here we are. These are the major rises over the month. No surprise at all to see Hypnosis Stocks Fund at the top because of its bids, of course. And I think below that, the trend I think that has struck me is that some of the really out of favor trusts that have either encountered difficulties or been marked down because of skepticism about NAVs have started to recover a little bit. So we're seeing some of the more speculative ideas, I think, just coming off their worst levels. I can't say they're in demand, but they're off their worst levels. So we've seen, for example, two of the three battery storage trusts did a bit better this month: Gresham House Energy Storage and Harmony Energy. And that's because they have reassured the market that the revenues are starting to improve in that sector. I think as well, it's notable here that we have Seraphim Space, which is a bit of a poster child for the growth sector, and that's had some demand for its shares come back. Schiehallion Fund, which is always volatile. So there's quite a lot of interesting trusts here, I think, on the move during what was generally a reasonable month for investment trusts. But I think whereas there was quite a lot of excitement in the FTSE 100 going to new highs, we didn't really see that replicated across the investment trust sector, where the gains were generally a bit more muted. But we didn't see many things going down. And I think, again, that was quite encouraging that although the gains were not necessarily huge on the upside overall, there were many more risers than fallers. So not many fallers. The one at the top had a very specific and strange issue, JP Morgan Emerging EMEA Securities, where it was named as a defendant in a Russian court case, which has really nothing to do with this trust, but it's got caught up in the crossfire there. And it does mean, actually, that the massive premium on which its Russian assets were rated has come down. Other than that, there's not too much to report here. We've seen some falls from some of the highly rated trusts with a lot of US tech exposure, because that's just come off the boil a little bit. So Manchester and London and Scottish Mortgage are on this list. But actually, these are relatively small price changes over the month. Partly because of that, I decided I'd focus on the discounts, and the market ratings. And I had a look through the list of Z-scores. Now, if you're not familiar with Z-scores, that's a statistical measure of how much the current discount is diverging from its average over a certain period. In this case, these are 1-year Z-scores. And when I was looking down the list, I found that there were 4 sectors that looked a little bit cheaper now than they have been, and 2 that were more expensive. So I'll just talk through those quite quickly now. The first sector where some trusts are trading on much wider discounts than they had been over the last 12 months is real estate. And that's no enormous surprise because, of course, this is a depressed sector, highly sensitive to interest rates. And I think as some degree of skepticism has arisen over the room that central banks are going to have for early maneuvering on cutting interest rates this year, so some of the discounts have widened in real estate. On the left here, we have the names of 4 trusts that I've picked out, but on the right-hand side, I'll just explain the format of the chart here. that it's color matched to, so we AEW UK REIT here in grey is the grey one in the chart. So the coloured bars are the current discounts and the black bars are the 12-month averages. And I think what's interesting here is that you can see these discounts are wider. AEW, I think, is a very strong trust. It has a really excellent track record, top of the sector over most periods. And its discount has widened out to 14.5% compared to its 9.5% average over the last 12 months. Life Sciences REIT is on a very big discount, just over 50% there, 51.7. And that's partly, I think, because of some disappointments at the pace of lettings there. But again, I think that's quite interesting with the average discount at 30. So that's certainly offering some value if you believe they can pick up the pace of lettings and really sort out their revenues there. The next one I think is really interesting, Real Estate Credit Investments. This is an income trust that actually has a pretty flawless record, which is quite impressive given that it's investing in real estate debt. And it's offering a very attractive yield on a wider discount than it normally is at the present time. And the last one with the absolutely massive discount is Phoenix Spree Deutschland, discount actually approaching 70%. Which is a peculiarity. And again, I think there's been some disappointment here that the trust hasn't cracked on at a rather faster pace with the apartment sales that it was promising. So we'll have to see if it can raise any extra value there and get that discount coming in a little bit. So I think there's still opportunities in real estate if you're feeling reasonably sanguine about what's going to happen to interest rates for the rest of the year. In renewable energy, I think there are still some opportunities here. This sector, again, interest rate sensitive and has been, it's come well off its peak levels, of course, and been out of favor for quite some time. I still think there are some opportunities here, but so you have to obviously look at the trust on a case-by-case basis. Here, I think Octopus Renewals Infrastructure, which is on a 31 discount compared to its average of 18, that has had some disappointments in its revenues, actually. And so, I think you need to look quite carefully at that trust. As well, it does have higher debt than average, which at the moment is a black mark. So typically, there are reasons for these wide discounts, but you have to gauge, of course, whether that really justifies them widening out quite to the extent they have. The other one on this slide, Gore Street Energy Storage Fund, I sense that this one's rather hard done by, actually, because the other two trusts in the sector, which have really been the ones that have suffered from the fall in the UK revenues from batteries, they both come out with statements suggesting that actually things are improving and their share prices have reacted. Gore Street hasn't done that because it actually doesn't really need to, because it doesn't have so much UK exposure. But its shares went down this month, and I think that's possibly creating a little bit of an anomaly here. The discount now is 45% compared to an average of 28.9 over the last 12 months. So in my opinion, that could be one to take a look at. The third sector I noticed is growth. And this maybe isn't really a surprise. Again, I think investors are wrestling with the temptation to buy back into growth at this point after some time out of the market, possibly. But clearly, as regards timing, it's not easy. And again, you've got to judge each trust on its own merits. Impacts Environmental, I think, is interesting. This is not always regarded as a growth trust, but I met the manager recently, and he was absolutely adamant that it's all about growth, this trust. It's not about producing income. It's really about finding good growth companies in that environmental space. And I think this trust is really the leader in the sector there. And for quite a long time, it was very highly rated, actually, as a result. And I think maybe just as green issues have slipped off the agenda slightly as we've been focusing on other geopolitical matters and also interest rates, perhaps this trust is now just sliding under the radar a touch, and you can buy it on a 12 discount compared to its average of 7.5. RTW Biotech Opportunities, that's another trust I like. This one, I think, has again just slipped off because it's perhaps digesting its recent acquisition of Arix Bioscience, and it's working its way through that. And also its largest holding, Rocket Pharma, has been a little bit weak in the US over the last few weeks. I follow that one closely. So again, the discounts just edged out to 33% compared to an average of 26. And the last one on this slide, Bailey Gifford Shin Nippon. This would be a bolder choice, this one, because its recent track record is really quite awful. I mean, I was wondering which word I should use there. That's clearly because of its growth bias in Japan, which has not been paying off for a while. But actually, I think if you look further back at its track record, it really was exceptional for a number of years. So if we do see growth companies coming back into favor, we could see a recovery here. And again, you're getting a chance to buy in on a 16 discount here, which is a bit wider than it has been, and certainly far wider than it was in past years. So if you're a contrarian investor, I think that's of interest. The last of the four cheap sectors now, emerging markets. I don't think these are spectacularly cheap, actually, and you'll see that the difference in the bars on the right-hand side is perhaps not as stark. But nevertheless, they are trading below their average multiples over the last 12 months. Scottish Oriental smaller companies, decent track record there, and actually 17 discount, which I think is quite wide compared to where it's been in the past, not just over the last year, but before that. 10% emerging markets. In my experience, this trust does tend to run a little bit hot and cold, and it tends to be either at the top of the performance tables or the bottom. At the moment, I think it's actually neither, but nevertheless, I think it's a trust that many emerging markets investors would still turn to, and it's on a 15 discount at the present time. And I think it's worth considering these global emerging markets trusts if you're reading about India or Vietnam or other exciting individual markets. I think it's important to bear in mind that those single markets really do come with a lot of added risk. And so actually having a diversified approach can pay off, in my view. Pacific Assets Trust is the third one on the list here. That's actually been quite highly rated, that trust. It had a very good performance period, and it's just slipped back into a double-digit discount. So those are the cheap ones, and there's two sectors that I think are a bit more expensive now compared to where they've been over the last year. The first one, probably no surprise, technology. There's clearly a great deal of enthusiasm at the present time about US tech in particular, and stocks like Nvidia and the Magnificent Seven. And the two trusts that are most obviously exposed to that are PolarCap Technology and Allianz Technology. I consider those two as twins, really. Their track records are very close indeed, and their rating tends to be very close. And they both come in, they're both on single-digit discounts now, 8 or 9%, compared to more like 12 over the last year. So they come in a bit. That does worry me slightly, because I think there's a fair bit of chat in the media at the present time about the high rating of US markets and about the possibility of a correction over the summer if these much anticipated cuts in interest rates don't really come through at the speed we're hoping. So I think I'd be slightly wary there. And the third trust in the table here is Herald, where again the discounts come into 11 compared to 14 over the last year. And historically, it had been wider than that as well. In this case, there's the additional factor that Herald was one of the trusts where Saba took a stake, and that, of course, enlivens matters somewhat. So I'll move on to the very last sector here that I'm going to talk about. And this maybe was one I didn't really anticipate so much, and this is the global sector. So some of the big international generalists have seen their discounts come in, really moving from typically slight double-digit discounts to modest single-digit ones. Not a huge movement, but nevertheless, I think it's notable across this sector. And there are a couple of trusts that are definitely trading at higher multiples than they have been, higher ratings, I mean. So Allianz Trust on a discount of just 2% compared to an average of 6% over the last year. That looks justified by its recent track record, actually, which is very good. And I think their multi-manager approach seems to be working quite well. They're just making a change, actually. They're swapping out Ben Whitmore at Jupiter because he's setting up his own boutique. And I was just thinking about that and thinking actually that when Alliance Trust decides to change a manager, it's quite a seamless thing and they can do it quite rapidly without any major upheavals for shareholders. Whereas, of course, if you're a normal traditional investment trust with a single manager, that's a much bigger deal. So I think at the moment, the multi-manager system is sitting quite comfortably in this sector. And also, otherwise, I think perhaps investors are just buying back into these major trusts because they're feeling a little bit better about global stock markets, but they're perhaps still somewhat skeptical about the NAVs in the alternative asset space, and that's not really something that applies here. Typically, as well, these trusts are more exposed to large caps, and maybe that's where investors are wanting to come back and get some additional exposure now. That's maybe why these discounts have narrowed. We'll never quite know. But anyway, I think at the moment in this market, there are still quite a lot of very attractive discount opportunities for investors. And there's quite a lot of movement in these discounts at the present time, which was really the point of me talking about it today. So as always, very important to do your research and check all your figures. That's it from me, James. Thank you very much.
Good. Thank you, Andrew. There was one question there from Tim Vernon saying, do we know why Gore fell and Harmony and Gresham rose?
I think specifically no, but I think it probably was just the market reacting to those two positive statements actually from both Gresham and Harmony, whereas Gore didn't put out a statement that I'm aware of, and so it could just be that. And the trusts are quite distinct because Gore obviously has a lot of overseas exposure that the other two don't have, so they are quite different.
Cool, thank you. And there was actually a question earlier on about splits and how they work. And I think what I'll do is I'll send the person who asked it something, but actually I'll talk about it more when we get that prospectus from Everforth, and I'll explain in some detail how it all works. Good. So let's move on. Good morning, Laura.
Hello, can you hear me okay?
I can hear you. Thank you very much for stepping in to do this. We really appreciate it.
That's okay.
So as usual, I'm going to let you sort of introduce the fund a bit first and tell us how it works, please.
Yeah. So Lowland, what is it? It's roughly 350 million market cap. Above that in terms of net assets, more like 420 million of net assets. All the reasons that Andrew was just talking about, really, that Lowland is at a bigger discount than it would normally be. The discount is around 12, sometimes touching 13 at the moment, whereas the long run average is more like 5, 6. So it is a bigger discount, and that means that the yield is also higher than it would normally be. So this is paying about a 5.1% dividend yield at the moment. We're not quite one of the dividend heroes. It's a long bugbear for this trust that we held our dividend flat during the financial crisis. So we're not one of the dividend heroes, but we haven't cut the dividend since the trust was launched, which is, I always forget, it was either 1962 or 1963. But anyway, we've never cut the dividend, and we try and make it very predictable for people, so we don't cut the quarterly dividend each time, so that people can effectively guess what the next dividend is. And what it so what is it? So it's a UK income trust, and what differentiates it versus most other UK income trusts is that rather than diversifying with income by going overseas, so often now if you look at the top 10 or the top 20 of UK income trusts, you will see in there some overseas holdings, whether it's, often it's the likes of Microsoft, or it might be some of the big pharma companies. I saw Stellantis in one this morning, which is a car producer. We don't go overseas in Lowland. Instead, to diversify, we go down the market cap scale. So you can hopefully see the slide here, which shows it. So orange is us and grey is the benchmark. We have much more than the benchmark in the FTSE 250 and below. And we only have about 45% odd in the FTSE 100. The FTSE 100, because it has, as you mentioned, James, because it has done better than smaller companies, the FTSE 100 has now become 85 or 84% of the overall benchmark. The benchmark has become increasingly large cap, but Lowland is much more small cap. We go down the market cap scale. And the reason we do that, because people often sort of say to me, well, why aren't you either just a large cap income fund or a small cap income fund? Kind of why do you have both? Why do you sort of go across the whole market? And the reason is that we think the two elements of the portfolio, in other words, large cap and the smaller mid cap, bring something quite different. So the larger companies bring often more defensive characteristics, think pharma companies, think utility companies, consumer staples. They're more stable, they tend to pay a higher dividend yield. And then the small and medium-sized companies these are companies at an earlier stage of their life cycle, they have a longer pathway of growth ahead. So they tend to bring faster sales growth, faster earnings growth, and therefore normally faster dividend growth as well, but from a lower dividend yield. And the two work, we think, well together as a blend within an overall portfolio, and they each bring something different. But, and I'm sort of cautioning this a bit, we have had more in the FTSE 100 over the last couple of years than we've had over the very long run. So over the very long run, we would have more like a third in the FTSE 100. And at the moment, it's more like 45. And the reason for that is partly passive because, again, as I mentioned, larger companies have outperformed, particularly in that Ukraine year, where the natural resource companies, the Shells and BPs of the world, for obvious reasons, did very well. But it's also, we've kind of got there over a period of time, and I know this is going back a long time ago now, but when Jeremy Corbyn was head of the Labour Party, all of the utilities sold off because people thought he was going to nationalise them if we ever got into power. We bought quite a few of them then, and they all are larger companies, they sit within the 100. And then during COVID, when all the money got printed, we thought inflation was going to be a problem when we bought a lot of the banks. And again, they all happened to sit in the FTSE 100. So the FTSE 100 weight went up kind of in two leaps, if you like, over a period of a couple of years. But now we think the best value in the market is at the smaller end. And by the smaller end, I almost mean anything outside of the FTSE 20, which has now become, those top 20 companies in the UK are now 55% of the whole market. The Astras of the world have done so well that it feels to me like they're almost sort of squeezing out everything else. Almost like what's happening in the States with Meta, etc., but with clearly a different set of companies. But we think the value is outside of those biggest companies, and so we're moving the trust slowly down the market cap scale, and I can give you a couple of examples later. But it's those more domestic and smaller businesses where we think the best value is at the moment. If we just flick on, James, to the next one, I just wanted to touch very briefly on recent performance. So over the last, so this is the 6-month period, which only because we're in the middle of writing our 6-month report. But if you go back for the last 18 months or so now, Lowland has just about outperformed, and it is pretty modest. And the sort of dynamics of that are the wind has effectively been in our face in that small and medium-sized companies have underperformed. But then on the other side, we've had a level of takeover activity that I have never seen in 15 years in the city. I think we've got 6 companies that are under potential takeover offer at the moment. All of that is known and out in the market. The likes of, well, I guess just because it's on the front of mind today, we've got the likes of Anglo American, but we've also had bids for things like IDS, which is Royal Mail, DS Smith, Hypnosis, which Andrew mentioned. And so what's happening is kind of the wind is in our face in as much as small and medium-sized companies are underperforming. But then at the other end, we've got takeovers happening, which is helping. And then there's also been the odd kind of what I would class as recovery share. So the likes of Rolls-Royce has been helpful. So those two things together have meant we've kind of managed to just about be neutral in it, or slightly better than neutral, in an environment where small and medium-sized companies, it has been very challenging, and it feels like sentiment towards the area is still pretty tough, and there have been outflows as well. So we're quite happy with that. And then in terms of income, I think I understand that it will be a focus for a lot of people. Maybe if we go to slide 7, this is the Lowland dividend over the very long term. And over this period, it's grown at about a 7% odd CAGR, but you can see that it's very clearly leveling off in the period after COVID, and sort of very gradually ticking up after that. And small and medium-sized company dividends got hit even worse than larger company dividends during COVID, because they do tend to be more, well, firstly, they're smaller businesses, obviously, but they're also more cyclical on average. So they were quicker to cut their dividend. And Lowland, until very recently, has been in a period of effectively growing back into the dividend that it already is paying. And those smaller company dividends have now come back. And last year, so this is the 2023 financial year, which is to the end of last September, the earnings per share for this trust was 6.7, and we paid out 6.25p in dividends. So we are now back covering that dividend, which, as I mentioned at the beginning, is now about a 5.2% yield. I wanted to give a bit more colour about dividends, though, because I think there's quite an interesting trend that we're seeing in the UK market at the moment. And this isn't just for this trust, this is more broadly, which is that special dividends are almost disappearing from the market. And the reason for that is that the marginal buyer of shares in the UK is increasingly US shareholders. And share buybacks have been a big, as we all know, share buybacks have been a big distribution mechanism in the US for a long time, but hasn't been so big here in the UK and in Europe. But the marginal buyer of the shares is a US shareholder that is turning up to these company management meetings and saying, I don't want you to do a special dividend, I want you to do a buyback. And if you're a company and you have this buyer that's telling you to not do that special dividend, whereas the UK shareholder probably is in outflows, and you're more likely to listen to that US shareholder and go, okay, well, I will do a buyback then. And you're probably also feeling a bit irritated if you're a UK management team at the valuation that your shares are on. So what we're seeing is those special dividends going and being replaced by buybacks. And at the same time, so many companies cut their dividend during COVID that they don't have a long dividend history anymore. So whereas the UK market, historically, there was such an entrenched dividend culture, and companies would try their absolute hardest not to cut their dividends. So even if their earnings fell, they would try very hard not to ruin that very long dividend track record that they had. Whereas now they've only got a dividend track record that's probably 3 years or so. So if you have a payout ratio that's 50%, say you're a company like Marshalls and you're building materials and it's a tough end market at the moment, and your earnings have fallen and you've got a payout ratio, increasingly you're just going to stick to that payout ratio. So you will just cut your dividend and you will not pay as much attention to that dividend history, because, as I said, it's probably only a couple of years. So what does all this mean? As a trust, as an investment trust, I think it's fine. And if anything, it's an advantage. We have a small revenue reserve. We have hundreds of millions of capital reserves that we can dip into. We just need to make sure that the board understands this dynamic, that shareholders understand this dynamic, and that's fine. And I think we can keep going. But if you're an open-ended fund and you're paying out everything that you get in any given quarter, I think what you're going to see is more volatility in terms of the dividends. So if you want predictability of income, I think that's quite a strong story in favor of investment trusts as an income vehicle. But I just think there's a different dynamic for UK dividends from now on that it's just worth being aware of. And so moving on to valuation, as I mentioned right at the beginning, Lowland as a trust is at a bigger discount than it would normally be, sort of 12, 13. But there's that valuation discount, but then there's also the valuation discount at the portfolio level. You mentioned, James, the Aberforth valuation right at the beginning. We're not quite at that level of valuation. This portfolio is more like 10 times historic earnings, and the long run average would be more like 13. What I quite like about that number, that 10 times, is that it is historic, so you can't debate it. I guess the question in the UK market is always, well, could you see a step down in earnings because the economy is not doing brilliantly? That is just a historic number. And I actually think there's quite a lot of earnings rebasing that's already happened within that 10 times number. So going back to a company like Marshalls, which is it's just paving slabs, roofing, that kind of thing. They've had earnings fall about 50% roughly within the last year or so. That is already within that 10 times number. So the way, and I'm sorry if I sound kind of over optimistic, but the way I sort of see what might happen in a couple of years, and we can never put kind of an exact timing on these things, is that there's a potential for some of these UK domestic businesses in particular where you could get an earnings recovery if the UK economy does a bit better, and a rating recovery. And those two things, if they could happen at a similar time, you get a compounding effect. So you get the earnings recovery, and then people feel more confident, and you also get a valuation recovery. We can never say, and this is an if, obviously, we can never guarantee anything, but that's quite powerful when those things happen together. And then if you wanted to be really, really optimistic, you could say, well, the trust is also at a discount. I heard Nick Greenwood from Premier Miton describe the UK sort of smaller company sector as a Russian doll in terms of the levels of discounts that you get in. And I thought, yeah, I'm going to nick that. That's a great way of putting it. But it genuinely is that there's multiple layers of discount once you get to the smaller cap end of the UK market at the moment. And if I'm just going to name a few companies on slide 9, if we flick over, James. This is only a couple. For Lowland, we've got just over 100 holdings, so it's not it's not a concentrated fund, but just to sort of name a few. We have been adding to some property names, so the likes of Shaftesbury Capital, which is property over in the West End. It's got stuff like Carnaby Street and that kind of thing. It's mixed use, and the likes of Workspace, which is flexible use. It's almost like WeWork, but it's a completely different business model in that they own the assets, but it is shorter lease office buildings. And both of those companies would be trading at substantial discounts to NAV, and yet both, I think, have good prospects in terms of rental growth. So particularly Shaftesbury, just you cannot replicate the assets that Shaftesbury has in the West End. And anyone that's been out in that area of London recently, I don't get to go often, I have very small children, but anyone that has got to go out recently will see that area of London is really, really buzzing and doing very well. And then the likes of, we've also added to some specialty services business, so something like FRP is restructuring largely. You could argue that they're a beneficiary of higher rates because it is pushing more companies, unfortunately, into administration, and FRP does the work for some of that. And then the likes of XPS Pensions, which is a specialist pensions consultancy business. These are the types of smaller companies that Lowland is going after at the moment. I'm going to stop there, but I think if we put up slide 10, which is the portfolio, then if anyone wants to ask questions about specific, well, this is just the top 20, but if anyone wants to ask more portfolio specific questions, we can have that up there.
Thank you very much, Laura. That's really good. Really interesting, actually. I mean, I actually just briefly, just to go back to that dividend thing. It is daft that you're not a dividend hero, really. I know you can see the sort of pause there, really, and every other. Yeah, there we go.
Those are the rules.
There's the rules. Yeah, exactly. Okay, so probably better to think about sort of the big picture first, if you don't mind. So, can you think where there might be catalysts for a re-rating of the UK market?
My number one question that I get in every client meeting. I suppose at the moment the catalyst is definitely takeovers, and I mean it when I say I haven't seen anything like it. It is every week, and I'm really not. I'm genuinely not exaggerating. It's every week at the moment that we're getting a bid coming in. That is the catalyst in that performance has been a bit better, but it's the reason I sound a bit reticent about that is that I do find it worrying how many companies are being taken over, and we haven't got anything sort of coming in the other side at the moment. Hopefully that will change. So that's the catalyst right now. I think as I kind of look ahead to later in the year, I think this is just my view. Other people would disagree, but I think Bank of England should just get on with cutting rates. I think the UK economy is in a different place to the States. So this kind of almost obsessive fascination with what the US economy is doing, and you can see it moving the UK market. I just don't get it. The UK economy is in a different place to the States. I think the Bank of England should just, cut rates, and I think that will prove a catalyst. Well, it could prove a catalyst, because I feel like we just need a bit of a momentum for some of these smaller companies. Again, if you talk to the likes of Marshalls, they really need the house builders to be building more housing again to get the demand going for that type of product. And I think realistically, in order for that to happen, we probably need an interest rate cut. So that could prove a catalyst, if it comes later. And again, we could argue it might be June, it might be August, it might be later. But I think that could prove a catalyst when it happens. I do think, though, I know I've just given you a couple of catalysts, but I do think trying to think of a catalyst is, if I'm being really honest, a bit of a waste of time, because I think people always, after the event go, oh, that was the catalyst. And you think, well, really?
Fair enough. The takeovers that we are seeing, are they coming at fair prices, or are things being sort of taken out cheaply?
It's a real mix. What I'm tending to find is that if it's private equity, I tend to find the valuations a bit stingy, if I'm being honest. Whereas if it's a peer company coming in, then there are normally costs that can be taken out, and you get to benefit from some of that as shareholders. So to give you an example, something like Devro, which we had taken over last year, which makes sausage casings, very, very Lowland, that company, that was taken over by a European peer. And when I saw the bid come in, I thought, yeah, that's a fair valuation. For that type of business, it wasn't a particularly, it's a perfectly good company, but it shouldn't trade on 20 times earnings kind of thing. So when that bid came in, I thought that was fair. Whereas we've had some others. I'm trying to think about some of the worst ones. Something like Finsbury Food, which makes cakes and bread and that kind of stuff. Again, it shouldn't be a 20 times multiple business, but it got taken over by private equity. I'm going to say it was something like 10 or 11 times earnings. Anyway, it was a very low multiple for a well-invested business with a good balance sheet, really solid management team, and that kind of thing. I felt quite aggrieved by. So it just really depends. Some of them are valuations that are perfectly fair, and some of them I don't think are.
Obviously, that's freeing up cash. There's a question about DS Smith, and I guess if you get a sort of largest position taken out, you then got to reinvest it. So have you got a sort of long pipeline of potential investments, or would you just add it to the existing portfolio? How would it work?
I'm sort of building up our list at the moment, because you're right. If we had all 6 of these go through, and they probably won't all go through, but say that we've got quite a lot of cash that we'll need to reinvest. At the moment, we're not struggling for ideas. So we've bought, for example, something like, I honestly never know how you say it, Dowlace. Anyway, the old GKN that came out of Melrose, it's a relatively new listing within the last year, 18 months. We've bought that. We owned GKN actually a long time ago before it got taken over by Melrose. We're effectively buying it back, but now it's just an auto supplier. The aerospace bit is still with Melrose. Something like that has traded very, very poorly since IPO, because the people that inherited it were Melrose shareholders and effectively didn't really want it, and it's gone through this period of sort of shareholder register dislocation. So we've bought a new position in that. We've bought a relatively new position in Smith & Nephew, which is medical devices. Again, it's been a pretty poor performer, sort of huge discount to some of the US peers. So we've got quite a long list of things that we're happy to buy. So at the moment, I'm not worried about it in terms of the UK market sort of slowly disappearing, but I definitely wouldn't want to see it carry on at this pace. I'm just hoping that this level of takeover activity gives a jolt to asset allocators, maybe the government, I don't know, because we wouldn't want to see it carry on like this. It's helpful for short-term performance, but it's not a particularly healthy dynamic.
When you are looking at new investments, is there a kind of yield target in mind? Are you constantly trying to improve the revenue of the portfolio, or is it just a mix of total return kind of objective?
Not hugely. We're not one of these we're not an income fund that says, look, every stock has to pay above a 4% yield or whatever it is. I think I tend to look for companies that are generating cash. Do you pay probably at least a 2.5% type yield? But I think we've got to be careful in that it's often the lower yield companies that are proving to be the best performers at the moment. So if you look at something like Rolls, that's been the biggest contributor for Lowland over the last year or so. And that, it might return to paying a dividend maybe later this year, but it pays no dividend at all at the moment. So I don't think we should be too rigid on looking for yield. And again, I think it's great to be an investment trust in that world where we don't, we just have a bit more flexibility on that than an open-ended equivalent would.
Obviously, it's great that the dividends covered this year, last year. How important is it that the dividends covered going forward? Because obviously there are some funds out there that consistently pay out of capital.
Yeah, I mean, I maybe have an old-fashioned view on this, so some might disagree, but we did pay an uncovered dividend during COVID, and I think sometimes people misunderstand the revenue reserve. The revenue reserve isn't a pot of cash somewhere that you can just dip into. If you're paying out of capital, as we did during COVID, given what happened with the dividends, you are finding that cash from somewhere, as in you are selling parts of your portfolio to pay that dividend. And that, to me, that works if you are going through a period where your NAV is growing strongly. If you're going through a tougher period, that really felt challenging. We were during that period where share prices had already been hit badly. We were going through thinking we need to sell something, and I wouldn't want to be doing that on a more long-term basis. Now, it was the right decision because we're back and we are covering the dividend, but I really wouldn't want to do that every year. The way I see it is that we should be covering it on an average basis. I won't worry too much if in any one year we don't quite cover it, but I wouldn't want to do that on a sustained basis.
Yeah, fair enough. Thank you. There's a couple of questions about specific investments you've done. Well, one is about the sale of AstraZeneca. Can you talk us through the thinking behind that, please? And also your purchase of Vanquis Banking.
Okay, so let's do Astra first. Astra has been, well, firstly, let me say it's been a mistake to sell it. I mean, it's been a phenomenal performer. Pascal has done a really brilliant job of turning around that business. It's very rare to see that type of turnaround from the cheapest in the sector to among the most expensive over sort of whatever it is, 15-year horizon now. I think it's hard to keep repeating the trick in pharma. It's an unusual business in this respect that, it's not like Diageo or something where you've got brands that effectively have as long as you keep them ticking over almost a sort of permanent life cycle. Whereas in pharma, things do just go off patent and you lose them. And as the company gets bigger, it's now a 50 billion or top line at Astra. You have to keep finding bigger and bigger and bigger drugs to keep the momentum going. And Pascal has done a fantastic job of doing that so far, but that does get trickier and trickier as you get bigger. And the shares are trading at a valuation premium to the rest of the sector. So sort of implying that they can keep doing that. Now they might, and they've had some brilliant success stories within it. But I think that will become increasingly challenging. Whereas we do hold Glaxo, GSK, that's trading on a much lower valuation. Sentiment is very different at GSK than it is at Astra, where GSK does have leading franchises in some areas like HIV and in types of vaccines. So we have a preference for GSK, but I don't want to deny that Astra has been phenomenally successful. In terms of Vanquis, it's not a new holding. It's been there as Provident for as long as I have been involved in this trust, and I think it was held long before that. It has been a big mistake. It's been it's a company where it almost seems to have been in turnaround for probably coming up to 10 years now under various different management teams. And most recently, it has had consumer complaints from one sort of claims management company that has meant costs have spiked up completely unexpectedly, not the fault of the very new management team. The valuation is very low. It's a small holding now. It's about 0.5%. I think my view is that it's too risky to add to at this point, but it's also very lowly valued, and that's reflected in the fact that it's a pretty small holding at this point.
Fair enough. Thank you. Can you tell us about gearing and how you use gearing within the portfolio?
Sure. The gearing's about 12-13% at the moment. That's roughly in line with where it's been historically. I mean, our view is that gearing is, along with the revenue reserve and things, is a big advantage of the investment trust structure. So we want to use it, and particularly at times when we think valuations are attractive, which is definitely where we think we are now. We would only, I think, market timing is not our. We're not trying to fool the market is what I'm getting at. So unless we have a very strong view that valuations are expensive, which James did have going up to the financial crisis, sort of to his credit, so he took it to net cash at that point. It's pretty unusual that Lowland would have anywhere near net cash. We tend to just keep it there, thinking that this is an advantage. We'll be able to do better with the dividend and capital than we can, it should be comfortably above the cost of borrowing. So gearing is almost structural in this trust.
Yeah, fair enough. I think it makes sense, really. Politics. I mean, obviously, I suppose given what's going on today, do you think a change of government's going to have any difference, make a difference to the UK market?
Maybe controversially, I think it might be quite helpful. When you talk to, we obviously meet a lot of management teams. When you talk to them, they tend to say very well. Maybe they would say this, but they tend to say very good things about the shadow cabinet, the engagement that they've had. I think it would be, if I'm being honest, sometimes it feels that you almost need a change to get things done. Let me give one specific example. A company like IDS, in other words, Royal Mail, we do probably need to change the universal service obligation, and I think Ofcom understand that, but it feels like there's almost this sort of stalemate until after the election, which is frustrating because they should, they could just get on with it and do it now. But there's a couple of areas like that where you feel you almost need the change to happen for things to get going. I think with things like the house building volumes, again, you might need to get the other side of an election before you really see that pick up again. So I'm looking forward to us being on the other side of it, actually.
Yeah. One question on here. I'm intrigued. How do you split the job between you and James?
There's no sort of formal split. If I was to very roughly summarize, James tends to do the smaller end more, and I tend to do mid and large more, but that makes it sound more formal than it is in reality. And there are smaller companies that I would follow very closely and larger companies that he would follow very closely, but very roughly, that's how we tend to do it.
Yeah, that makes sense. Thank you. Cool. And then I suppose the last question on here is really about the discount. Do you think that's just a question of narrowing it with performance or buybacks, or how do you think the best way to tackle that is?
I think it probably has to come through a combination of performance and also sentiment. The way Lowland tends to trade is it almost trades as a proxy between UK income where it sits and UK smaller companies, because people know that we do have a sizable smaller company element in there. So the discount it looks an anomaly compared to its UK income peers, but it also tends to trade with UK smaller companies where discounts are generally quite wide at the moment. I think for it to come in, it definitely, performance is always pretty crucial to these things. It definitely needs that, but I also think it probably needs better sentiment towards the UK more generally, which tends to impact smaller companies more. I think it needs a combination of those things.
But of course, now it's still part of the attraction, as we've explained, for the many layers of discounts. Thank you very much for doing this morning, Dora. It's been really interesting.
Thanks for having me.
We'll get you back again in a year or so and see how it's been going. But thank you.
Thanks.
So we will be back next week talking to Richard Pinder of Literacy Capital. And we have a full lineup, as we've explained before. So have a good weekend, long weekend, and I will see you next Friday. Thank you.